Good afternoon, everyone. Welcome to the Monetary Policy Committee press conference. And I'm sure that we have a lot to discuss today. Since the meeting in July of the Monetary Policy Committee, domestic inflation has moderated to lower than expected levels, and it is anticipated that it will remain within the target range for the rest of the forecast period. Contributing to this development were the further appreciation of the Rand exchange rate and the relatively weak domestic demand conditions. The output gap has remained negative, and economic growth in the second quarter of 2010 was lower than market expectations. Growth is expected to remain below potential for some time against the backdrop of a fragile global economy. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, declined to 3.7% in July 2010, compared with 4.6% in May. Goods price inflation measured 2.1% in July, while services inflation, which had been relatively sticky, declined to below the upper level of the target range and measured 5.4%. The categories of housing and utilities, mainly electricity, and miscellaneous goods and services, predominantly insurance costs, together contributed 2.2 percentage points of the 3.7% inflation outcome. However, electricity price increases were lower than expected. There was also a quick reversal of the influence of the FIFA World Cup on some categories. This was particularly noticeable in the category of hotels, which experienced a month-on-month price decline of 11.2%. CPI excluding administered prices measured 2.9%, that is below the lower limit of the inflation target band. The recent upward trend in producer price inflation was reversed in July, when it measured 7.7%, having peaked at 9.4% in June. Food price inflation remained benign, with agricultural prices increasing by 0.2% on a year-on-year basis, while manufactured food prices declined by 1% over the same period. This suggests that food prices at the consumer level are likely to remain contained for some time, notwithstanding higher global food prices. Partly as a result of the recent lower than expected inflation outcomes, the inflation forecast of the bank was revised downwards, particularly in the short to medium term. Targeted CPI inflation is expected to reach a low point of 3.7% on average for the third quarter of 2010. And inflation is expected to average 4.8% in 2011 and to measure 5.1% in the final quarter of 2012. The low inflation trend has had a favorable impact on inflation expectations in the financial markets. Break-even inflation rates, as measured by the yield differential between the conventional government bonds and inflation-linked bonds, declined across all maturities since the previous meeting of the MPC, and remain below the 6% level. The Reuters survey of analysts published in September also shows an improvement of expectations, and their inflation forecasts say that it would be expected to average 4.6% and 5.2% in 2010 and 2011 respectively. The global economic outlook continues to be characterized by heightened uncertainty. Although fears of a reversion to recession in the advanced economies have diminished somewhat, the downside risks remain high. During the course of the year, forecasts of global growth have generally been downgraded in the wake of the European sovereign debt crisis, high rates of unemployment in the US and the euro area, and weak demand in many of the advanced economies. The US economy is expected to experience below-trend growth for some time, and doubts remain about the sustainability of the fiscal austerity programs in some of the southern European economies. A number of Latin American and Asian economies, apart from Japan, have maintained their strong growth performances, but China has experienced a moderate policy-induced slowdown. While the low-growth global outlook poses a downside risk to prospects for domestic economic growth, inflationary pressures emanating from the advanced economies are likely to remain benign. The hesitant global recovery has also helped to maintain international oil prices in a relatively stable range of between $70 and $80 US dollars for some time to come. These international developments also imply that policy rates are likely to remain abnormally low for an extended period of time in a number of the advanced economies. The resultant search for yield by foreign fund managers has had implications for the rand exchange rate, which remains the main downside risk to the inflation outlook. Since the previous MPC meeting, the rand has appreciated by about 4.6% against the US dollar and by 5.6% against the euro. On a trade-weighted basis, the rand has appreciated by 4% since the July meeting and by 5.7% since January 2010. Since the beginning of the year, non-residents have been net buyers of equities and bonds to the value of 100 billion rand, of which 75 billion were bond purchases. This compares with net purchases of bonds totaling 15.5 billion in 2009 as a whole. Whereas in previous years bond flows appeared to be mainly speculative in nature, the recent developments suggest that there could have been a fundamental shift in these flows. There are indications that a significant proportion of these flows are more long-term in nature as foreign pension funds and other fund managers take advantage of higher yields in emerging market economies. The higher level of bond market inflows are not unique to South Africa. It is estimated that emerging market bond funds have recorded year-to-date inflows of 32 billion US dollars, compared with the previous full-year high of 9.7 billion US dollars, which occurred in 2005. The appreciating trend of the rand exchange rate has been sustained, despite further accumulation of foreign exchange reserves by the Reserve Bank. The bank does not target a level for the exchange rate, but takes advantage of prevailing conditions to continue to build reserves. However, this is a costly exercise, and in order to sterilize the impact on the money market, the bank is now engaged in a longer-term foreign exchange swap transactions. This in effect results in an overbought foreign exchange position and adds to the international liquidity position, but not to the gross reserves. Gross reserves will only be affected if and when these swaps are not rolled over and the bank takes delivery of the dollars. Any profits or losses will be borne by the National Treasury in keeping with its stated commitment to support the bank in its reserve accumulation efforts. A few extra comments here are in order. This changed approach is in line with our modified monetary policy implementation procedures. We began conducting longer-term foreign exchange swaps during the month of August 2010. The transactions can be conducted for up to 12 months. They give higher levels of flexibility for general domestic money market liquidity management, as well as for the sterilization of foreign exchange purchases. In essence, the bank buys foreign exchange in the spot market, swaps this into the forward market, thereby providing greater flexibility to accumulate foreign exchange reserves. Existing or newly acquired foreign exchange reserves can form part of these operations. The approach facilitates the accumulation of larger amounts of forex during times of increased flows, depending on market conditions. Domestic economic growth declined in the second quarter of 2010 to a quarter-on-quarter annualized rate of 3.2%, following a growth rate of 4.6% in the previous quarter. The slower growth was due mainly to the 20.8% contraction in the mining sector in this quarter. Growth in the manufacturing sector moderated to 6.9% from 8.4% in the first quarter, while the tertiary sector grew at a rate of 4%. Growth in the second half of 2010 is expected to moderate further. The composite leading business cycle indicator of the bank declined in May and June, suggesting a slowdown in the pace of recovery in the coming months. Although the RMB-BER Business Confidence Index rebounded markedly in the third quarter following the second quarter decline, the overall index remains below the 50 level, and confidence has remained particularly weak in the manufacturing and construction sectors. The Kagiso BER Purchasing Managers Index increased slightly in August, but it nevertheless points to a deceleration of the growth momentum in the manufacturing sector. At the same time, manufacturing capacity utilization, which increased moderately in the second quarter, remains below the long-term average. The construction sector also continues to be under pressure, as evidenced in the low growth in building plans passed. Growth in private sector gross fixed capital formation was 0.4%, up from minus 0.7%, and is expected to remain subdued. The bank's forecast of GDP growth has declined moderately since the previous meeting of the MPC. Growth is now expected to average 2.8% in 2010 and 3.2% in 2011. Household consumption expenditure has shown some signs of recovery following the contraction during 2009. Growth in real final consumption expenditure by households moderated to an annualized rate of 4.8% in the second quarter of 2010, compared with growth of 5.7% in the first quarter. The impact of the World Cup on expenditure is unclear at this stage, but some moderation can be expected in the coming months. Motor vehicle sales have shown a particularly strong year-on-year recovery, although off a low base. The outlook for household consumption expenditure continues to be affected by contradictory forces. The main negative factors include low levels of credit extension, high levels of household indebtedness, high levels of unemployment, and continued job losses. Underlying credit extension remains weak, but there has been some improvement in the past months. Growth over 12 months in the bank's total loans and advances to the private sector measured 1.7% in July, its highest level in over a year. Growth in mortgage advances, which measured 4%, was the main driver of this growth. Installment sale and leasing finance, as well as other loans and advances, continued to contract, but at a slower pace. Growth in the retail portfolios of banks remained weak, and the ratio of impaired advances to gross loans and advances amounted to 5.9% in June, relatively unchanged from the previous quarter. Although banks appear to have relaxed their credit criteria somewhat, they remain relatively cautious, and their pricing for risk still appears to be higher than was the case before the crisis. Consumers are also constrained by high levels of debt, although the cost of servicing the debt has declined in line with lower interest rates. Household debt as a ratio to disposable income has moderated very slowly from its peak of over 80%. Household consumption expenditure is also expected to be constrained by the continued unemployment trends. According to the Quarterly Labour Force Survey of Statistics South Africa, the unemployment rate increased marginally in the second quarter of 2010 to 25.3%. In the 2 years to the second quarter of 2010, 1 million jobs were lost, while the number of discouraged workers increased by 900,000. Consistent with the slowdown in manufacturing and construction, job shedding was most marked in these sectors. Factors that could provide a positive impetus to household consumption expenditure include lower nominal interest rates, lower inflation, positive wealth effects from improving house prices and equity market developments, and high levels of real wage increases for those who are in employment. Wealth effects over the past year have been positive, with house prices increasing at year-on-year rates of over 10%. However, in July, the rate of increase declined moderately according to both the ABSA and FNB house price indices. The bond market rally has continued, and equity prices have recovered significantly from their lows in the first quarter of 2009, although they still remain below pre-crisis levels. Wage settlements in excess of inflation, while providing a positive impetus to consumption, are also the main upside risk to the inflation outlook. Some wage demands and a number of settlements have been made without regard to the lower inflation outcomes and the improved inflation outlook. Unless accompanied by higher productivity, such settlements could put pressure on domestic prices and impact negatively on our international competitiveness. Such settlements are also likely to have a negative impact on employment trends. Risks from cost push pressures are relatively unchanged. Administered price increases remain on average at elevated levels and therefore place upside pressures on the inflation outlook. Potential risks emanate from food price increases at the global level, particularly related to wheat prices. However, the impact domestically is expected to be constrained by the relatively strong exchange rate and the recent domestic bumper maize crop. So what has changed since our July MPC meeting? We are well within the target range. The inflation is down. The inflation outlook is benign. We have had a low point of 3.7% compared to what was anticipated at 4.9%. The growth outlook has deteriorated somewhat with lower forecasts and continues below potential. We need to have above potential growth for a number of years to get back to the growth trend. Manufacturing production capacity still has excess, and therefore there are consequently few or low inflationary pressures from this source. The exchange rate is stronger than anticipated. There's a continued expectation of capital inflows for much longer. Demand side pressures remain subdued. There's continued job shedding, and household debt to disposable income levels remain high. The global environment is even more uncertain, and it is anticipated to remain lower for longer. Therefore, in our view, there is room to move, and it is our responsibility to do so. The assessment of the Monetary Policy Committee is that the improved inflation outlook creates sufficient room for monetary policy to provide an additional stimulus to the somewhat fragile recovery of the domestic economy, which remains vulnerable to the uncertain global environment. The MPC has decided to reduce the repurchase rate by 50 basis points to 6% per annum with effect from the 10th of September 2010. The MPC views this action to be consistent with the continued attainment of the inflation target, having given due regard to the risks to the outlook. The scope for further downward movement is seen to be limited, but this will be assessed on an ongoing basis. Our approach remains forward-looking and is informed by close examination of the data and future developments. Thank you very much. I can see the hands. Okay. Miriam, shall we start with you?
Thank you, Governor. Was the decision unanimous this time? It sounds like it was. And what is the bank going to do if the rand remains as strong as it is, given that people say another rate cut wouldn't make much difference? Is the bank capable, through reserve accumulation, of curbing strength in the rand? Are other methods a good idea? How concerned is the MPC about its strength at this point in time?
Yes, the decision was unanimous, but as always, a considerable amount of time was spent on the detail of the data and its implications and assessing that, as we would normally do. But the decision was unanimous. In terms of the strength of the rand, obviously it is a concern, and we've indicated the approach we're taking around the way in which we can take advantage of the inflows. As I think everyone appreciates, what's lower for longer in the advanced economies has the consequential impact of currency flows to emerging markets, and I did give some indication of the scale of that into the bond markets. And we will continue to discuss with the National Treasury and ourselves to see what we can do, what is feasible, what is possible in the circumstance, and as appropriate advise the market. Yes.
Kositam from Summit TV. How long do you expect the rates to remain this low? Is it until the year end, or could we expect a quick reversal before the year is out?
I thought I gave the guidance that I could give, is that we said the scope for further downward movement is seen to be limited, but we will assess this on an ongoing basis. Obviously, it depends what happens with the data, at what point we are in the cycle makes the data more critical, and we will continue to evaluate our situation and take whatever decision is required. I don't think that is about signaling end of year or when. This is where it is, and that's the signal we can give. Yes.
Governor Renee Volgraaf from Soccer 24. In the light of all the external factors working onto our economy at the moment, does the MPC think that 50 basis points is enough to help economic growth? to above potential levels?
It's a contributing factor. It is not the only factor. I think the question is that you do not have a silver bullet either in your interest rates or in your exchange rate. It is a cohesion of policy that is required and a common purpose in what we need to do. So the Reserve Bank plays its part in contributing to that. But, this was the decision that we felt was appropriate. And that's the decision we took. Yes, sir.
Hi, Governor Marcus and the rest of the MPC. Perhaps before I carry on, if I may just apologize once again for sending out that headline before the meeting. It was an honest error, and we are dealing with it to make sure it doesn't happen again. In terms of, you said in your statement that...
Sorry, can I just reply? At least you didn't say, you happened to send out the right one, in that the bank lowered interest rates. Imagine what it would do to us if you said we had raised...
Well, exactly, but the consequences would have been...
would have been a little unfortunate for you, but obviously I'm sure there are lessons learned there for all of us.
Thank you for understanding that, Mrs. Governor. And just if I may ask, you mentioned in the statement that you don't see much more scope for downward revisions to the interest rate. Can you maybe give us some color as to why you see that as being the case?
I thought that, as far as possible, we've actually set out where we see the numbers, and that if you look at the real interest rates that would then be prevailing, this is the lowest level of interest rates for decades. The numbers will determine whether there is further room. But as the numbers stand, we think that this is where, with the current circumstance, it's appropriate. We reserve the right, obviously, taking account, because the globe is very unpredictable at the moment. It's very uncertain, and depending on what happens, we will take the necessary measures. The economy is actually growing. It's not as if we are in some of the situations that other countries are in, and therefore this is a step to support that, because we regard the globe as uncertain and our own recovery as fragile. But it is a combination of factors that need to be given effect to ensure that the recovery continues and strengthens. And so at this point in time, this is what our outlook shows. Let's see if the other hands. Yep. You need to put your microphone on. Thank you.
You raised concern about the above-inflation wage settlements. Are you willing to comment on the public servants strike, the 7.5%? Are you alarmed at what you see?
I think we've said what we want to say in the statement about it, and I think the issues around the public sector strike is a matter for government to deal with. You need to put your mic off, otherwise somebody else's mic can't go on. Miriam, we'll come back to you because I can't see any other hands. And I'm going to ask my colleagues to also respond.
Okay. I think one of the concerns voiced by economists has been that if there was another rate cut, it might hasten the moment for a rate hike. And there are mixed views as to whether this could happen, at what point next year. Is the bank comfortable that this rate cut is one that could be appropriate for some time? And would you be able to give us any indication of that length of time? I also wondered if someone could give us some background information on the interest rate, which I think even when you take the bank rate into account before the repo rate, we'd kind of like to know whether, this is the lowest since when.
Maybe somebody else would like to tackle those. I think just to respond on the question of when it would rise, you're talking next year, we're not. We haven't given any indication as to whether we would raise rates. We would consider the data, and when appropriate, we will raise rates. So in your question, you said next year, so don't assume we are agreeing or disagreeing with that. We haven't given any indication of that. We've given our outlook both in terms of growth and in terms of interest rates for the forecast period, which is to the end of 2012. That is based on what we anticipate and what we can see. Should the situation change, we will respond accordingly. But it would not be correct for us to say, to concur with you that interest rates may rise next year. That is the views of some economists. It's not the view of the bank. We will take that decision depending on the data that we see. But perhaps in terms of the interest rates, would somebody like to respond? Mondi?
Well, unfortunately, we do not have the quarterly bulletin with me to look at the time series and to see when was it that the bank rate was at the current levels. But one could, I think it's probably around 30 years or so.
Yeah. It was in the
70s. So it's more than 30 years now.
Johan, I don't know if you've got the detail on that.
Yeah.
You need to switch yours off then, Mondi.
Governor, I did not check the repo rate itself, but as far as the prime interest rate is concerned, if it goes down by a half percentage point to 9.5%, that will be the same rate which was ruling right through 1980. In 1981, January, it changed to 10%.
So as I said, it was decades since it was last at this level. I don't know if anyone would like to add. Mondi, did you want to add anything else? Anyone else? Any other questions? If not, thank you very much for coming, and thank you for your continued attendance at our press conference. And we look forward to seeing you again in November, if not before. Thank you. Bye-bye.